Good day. Ira Epstein of Linn Associates with your agriculture wrap-up for this Friday. And this is December 6th, 2019, and we're about 3:40 in the afternoon, so the stock market is still trading. A lot of the markets are, but you're looking pretty close to the settlement prices. The grains, of course, have finished. Now, the event that's coming up, in 9 days, we'll be hearing whether or not the U.S. and China trade deal is going to happen. I did a lengthy interview this afternoon with the Wall Street Journal, Dow Jones Newswires, and I told them this is how I'm viewing it. Whether there's a deal or not, the minimum I expect on December 15th, and I could be dead wrong, of course, is an extension. That's the minimum. Wouldn't surprise me if we get to a phase one. And the question was, why not just the tariffs on? And I said, why would the president give you that for Christmas when he could just as easily hand you that after the first of the year? And then guess what? Because of the extension, the stock market, he's not disrupting it. Maybe a good year end there. Unemployment numbers today, 3.5% unemployment, blowout numbers. Why upset the apple cart? That's at a minimum. That doesn't mean he doesn't go ahead in January. If we get to a phase one deal, that's probably the end of as far as you're going to get until after the election, and the Chinese get to see what they're dealing with and who they're dealing with. So let's see where that all falls in. Could I be wrong? Of course I could be wrong. So in looking at the markets in the monthly area chart of soybeans, we've been discussing in our office whether or not we think that for over the next 45 days or so, the market doesn't just look at it and say farmers selling abates a bit. I think the office has agreed with my take at this point, could be wrong in 9 days, that we get at the minimum an extension, and that the market will figure out what to do from there. Farmer selling backs off due to taxes. So the market came down, did get back to the 18-month moving average, and so far has held that. You can see the correction that has hit on a weekly bar chart where the market has come from this 940 plus area into this low of the 867 level. So it's about an 80-cent drop that the market had. We then continue to look at the swing line, and we continue to see now this pattern that we've had for a while of lower highs, lower lows. Therefore, we still have a pattern on the weekly charts that is still in the bearishness. We see a market, and I'm going to come back here, that last week tried to extend the break. Last week's low was 875 3/4, and suddenly the market seemed to have found its footing and came back to that 18-week average. I consider the 18-week or the 18-day to be like a line in the sand. Markets often like to pivot around them to see what happens. So if the market rallies from here, number one, you still have the pattern of lower highs, lower lows until you take out 929 3/4 under the current pattern. Resistance starts at 892 1/4 up to 909 3/4, the 100-day average. Where was the support in the market, or is the support in the market? Way down, 834.5 or so. That's one of the support numbers. It's a lower Bollinger Band number. Now, Bollinger Bands, reason there's an S after it, there's two of them. There's a top band and a bottom band. I consider this a resistance point, that a support point. And the fact that the market's fairly wide gives it more credence. Now, when the market really narrows in a lot, this was more narrowing, but not enough for me to say anything. I'll show you where I consider the narrowing. That's what I call narrowing in. I don't have that. So I can see a broad swinging market. I see a market that still has downside momentum. It hasn't quite turned, but it is trying to flatten itself out, rallied back to resistance. Why do I think the 45-day pattern or so? Well, if you start thinking about it in February, we're going to start talking about planting intentions in different parts of the country. If you're a grain trader, you realize that. And the question is, what does the president, or what can the president get out of China in the way of soy purchases? If you think they're going to just double things automatically, I wish you the best. I don't think that. In the meal market, it's similar. You've been hanging, in fact, out of the last 4 or 5 weeks, right at that 18-week average. You're narrowing in. You can see that in the Bollinger Band. You had been coming down, momentum-wise, and the market sort of ran out of that, and it's getting a bit of a reversal. In fact, if we go back to last week, we had a high on the week of 350 and a low of 290.60, and this week we had an outside week where you took out both the low and the high of the week, and you finished out the week actually right slightly under that 18-week average. So I'm going to call that an outside week to the upside. If you take out this low, this week's low of 290.50, you have in play then the lower Bollinger Band. If you rally from here, even if you were to get up over this last high that we had, and that's right up here at the 307.90, I still have another resistance point, in fact, a couple of them, of a lot of resistance there. In other words, I'm wondering if the grain market isn't ready to go to sleep on us. That's one of the things that I'm considering. In soy oil, notice how the break did not get back under this 18-week average. So this is still the strength of the market on the longer term. And these are longer term charts, not the shorter term. They're 1-week charts. You still have the pattern of lower highs, lower lows, which has been countered all the way through because the market has been able to stay over that 18-week average. In addition, you had a bullish crossover. Even though prices were falling, watch your 18-week average, it gets over the 100-week. That's a sign of support, not weakness, and that's because it's offering you two support zones under the market. Obviously, the lower Bollinger Band far away. In the corn market, the market fought a battle, fell back to the 100-week average, gave it up for about 2 weeks. That's about all. And you've come right back into that area. Now, the overall trend still bearish. This is not acting good, but what else has it done? In the process, you've got lower highs, but you have higher lows. So you've taken some of the oomph out of the market to the downside. You see that in the momentum. If the market takes out 362.25, I think you'll get the bears pumped up again. That could give you, if that were to happen, somewhere along the line here, unless you got over 402.5, lower highs and a lower low that could carry down to that 342 number. To get a good rally going, this week what's going to happen is this Bollinger Band is going to fall even further. It'll probably get very close, if not under, that last high. It's falling about 6 cents a week right now, 4 to 6 cents. So I'm going to guess that 402.5 area is going to be a resistance point if it can muster up a rally there. In the wheat market, we saw 2 weeks ago as the market fell into the support of the 100-week average and the 100. Couldn't get under either, rallied up to the Bollinger Band. What's my theory? First time you hit a Bollinger Band, be it on the upside or the downside, is where pros start taking money off the table. I'm assuming to get up there, they've been long. I'm assuming to get down to the number, they've been short. You may not agree with that, but that's got to be the assumption on it. And then 95% of the time, the market stays within the band, especially if the market's in a broad band. The narrower the band gets, think of it like a spring in a pipe. It gets power to move from there. In the cocoa market, again, we had a fairly narrow move here, and then you just countered the whole thing. Once you got over that 18-week average, you didn't look back. Pretty difficult market, too, because you made a lower low, then a higher high, and you get to see that right here when you cross that high, and you just caught everybody in this market. So you get to the upper Bollinger Band, and I realize people are getting wildly bullish, but that's typical of what happens. Then the market begins a bit of a correction. Momentum-wise, still up. In terms of a trend, not quite there. You got a lower low and a higher high, but you certainly have upside bias. On the weekly chart of sugar, you've been in an uptrend for quite a while. You got into it back at the very beginning of October when you crossed over the 18-week average, and since then you've been able to layer higher lows, higher highs, and you're still in that pattern as momentum is still pointing up with layers of support between the 100-week average and the 18. In addition, once this market got over the 13 cent a pound area, which it hasn't done in months, you'd have to go way back into a year ago October. That's not this October, that's a year ago October. To get to those numbers, it was able to get people saying, maybe this market's made an important low at this 10.5 zone. Coffee market, still going with the pattern of higher lows, higher highs, moving to the upside. Indonesia's in a drought. You've got a situation here where coffee has made a statement. I think that it said that this 90 to $1 area is a very important low in the market, and it's acting like long-term it's moved away from that. In the cotton market, now, cotton's interesting in the sense that if we think about it, a U.S.-Chinese trade deal probably helps a certain amount of the cotton trade. One of the things I've been watching over the past couple of weeks is I've noticed a lot of commercials buying calls, which seems strange as they were gathering their crop, but that's one of the things you look at. The pattern had been lower highs, lower lows. I want you to look at what happened. The previous high is 64.91. Today you got up to 64.75. Should this market take out the 64.91 level, you could end up then with higher lows, a higher high, possibly calling for a challenge of that 67.22 area, but more important, you're back into the uptrend. You had the uptrend develop here with the higher lows, higher highs, and the first challenge of the upper Bollinger Band resulted in a correction. As it turns out, textbook, it goes back to the 18-week average, and now it's trying to reset itself as to what it wants to do. Cattle is still in a bull camp on the longer-term chart. You've got higher lows, certainly higher highs. Momentum is still bullish. Bias is up. Haven't been able to get back to either the 100 or the 18-week average of closes. If you clear the 122.07 level, what's above the market to stop you? The next Bollinger Band. And yes, we have a layer of resistance up here, but that's closer to the 125, 130 zone, and that's where this resistance begins, 12600. In the lean hog market, as we look at what hogs did for the week, they're down. Now, China today relaxed some of the rules for state-run companies to begin imports of soybeans and pork. Doesn't mean they're going to do it, and the market still hasn't seen that. You still have momentum locked in, still into the bear camp. This overall trend is lower high, lower low. We have two levels of resistance here, and the market has not responded so far to anything that's friendly in the marketplace. And we have plenty of hogs coming for the packer. The packer margins are monstrous, but the price for the live animal per pound, not good. You're seeing that right through here. Eventually you'll bottom. I don't know when. And so far the news out of China hasn't moved the market. I teach what I'm doing here in a big way. All right. What I have is a course and research. Now let me explain first what my Cyber Week sale is. It's going to end this coming week. So if you want to take advantage, give me a moment here and I'll explain it. Free access to my charting course. If you go on the website, you can buy it right now for $179.95. You're going to get it free. And how you get it free, and by the way, what it teaches you are the 5 steps that I think make up an analysis of charting. Can you add more to it? Of course you can. I don't walk on water, but I think if you look at this, you get a way of looking at charts. And frankly, I don't care if it's a stock chart, a futures chart, a chart out of an Excel spreadsheet. A chart is a chart. And I'm going to cover for you in detail in this chart with 54 videos. It's going to be about 6 hours total time. You learn the swing line. You're going to learn moving averages. You're going to learn how to put the slow stochastics on, Bollinger Bands, window envelopes. It's going to be 5 steps. If I missed one, I'm sorry, but they're there. Now, they're not just the things you're seeing here. I use more moving averages than you see. I never talk about the window envelopes on a scale of 1 to 10. Believe me, they're super important. That's why they're one of the 5 steps. So you get that. You're going to have access to what I'm doing because you're going to be getting your research, right? So I want you to get that. You're going to get the charting software so that you can work with our program. I'm assuming you haven't used our charting software recently, but we have 2 different versions we can give you. All that's required is you to decide if you want to take one of my research packages. For a year, they start as low as $156 for the year. So it includes $179.95 value for just the charting software. And at the very least, you can give this as a gift. You're not required to start the charting software the day you get it. Let me say charting, the course the day you get it. The research is going to start right away. But you tell us when you want the course, and we'll tie in the charting software at that time. To find out more, just go to our website, www.iraepstein.com. If you're on my mailing list, you've already received emails about it. And remember, it's going to end this coming week. You have a good one. I'm Ira.